So we have an exciting session for you guys here today. As you know, you've all met, most of you know Abdulrahman from before. A lot of you met him a couple of months ago in person when he talked to us a bit more in terms of defensibility, and a lot of you have implemented that into your startup. Today is a bit different. It's a different type of defensibility. It's more focused on how to deal with investors and how to work with them and how to raise funding moving forward. So, exciting session. As we always like to say, let's keep this interactive at any moment, at any time. Please feel free to raise your hand and ask as much questions as you guys want. Abdurrahman might not look as friendly as you think, but he is friendly. He might bite eventually, yani, or sometimes, but yeah, yani, we'll be sure that it's a rough bite, but you'll take it forward. It's
I
fine. The
I took
information you
my
get is
shots.
more
I took
important.
my shots. It's
Yes,
you won't need any.
exactly. So, with that being said, Abdurrahman, I'm handing over the floor to you.
Okay. Well, nice to meet you all. Um, I used to when talking about this topic, I used to go through a bunch of slides, but I've decided that this does not work. So I'm skipping all the slides. This will be purely conversational, because fundraising is a very deeply personal thing, and you will all face different objections from different funds depending on your stage. Um, so the way I'd like to focus the discussion is going to be before the raise, during the raise, and after the raise. Okay? But to make sure that I cover all of your points and I don't just go on my own tangents, which I am prone to do, I want to hear from you guys what your frustrations are in terms of fundraising. What gives you anxiety? What drives you insane? Just so that I address every single point and I make sure that I take it into consideration. So I'd like you to start by kind of shouting out or typing what things drive you insane about the fundraising process, and then we'll try to see what we can do to make it less painful. Yes,
And,
thank you, Safe. I don't know if
and,
political.
I can start saying a few things.
Yalla, go ahead.
I think one of the biggest challenges is kind of understanding what exactly they want. So what is it? Is it the multiples? Is it the sector? Is it the so kind of having a clear grasp on what it's going to, because usually like kind of you go presentation and you have a new idea of objection. That's kind of always the wave or the next meeting. Or so how can you kind of look at it from the other way around, where what are they usually looking for to kind of, okay, let me look at that checklist and pass it. So that's kind of
Okay, so
a
it's
quick thing.
not clear what they really want. I can achieve all the targets that they claimed they wanted 6 months ago, go back to them, and they still don't move. So unclear. Like it seems a little bit ambiguous. It's not as clear as build a great company and reach X ARR and then we'll automatically invest. That's not quite the case. We're seeing companies that don't have those metrics raise funding, and we're seeing companies that do have those metrics not raise funding. So it does feel a bit a little bit murky, a little bit unclear. All right, so unclear on real proof points. What else? Go ahead, Mohammed.
I think I tend to agree with what Yusuf was saying. So these are the preliminary, I think, common problems that all of us face. I mean, not sure exactly what the mandate is, because the mandate, or which we usually see it on their websites online, I think that's something. There are times that the actual is quite different. I think the second biggest issue, which is more emotionally related, I'd say, is basically how they're moved by the wave itself. So they're actually, what we have seen is the investors, they usually follow the wave, the trend, what's happening in the market. So it's not very prone to exactly the business that you're into. So for example, if fintech is on the hype, everybody's just want to ride the same wave. If let's say e-commerce is on the hype, they follow that, and then similarly AI and etc. etc. So there is a lot of bandwagoning, I would say, and the problem with the Saudi market, which we have found, it's a very small market in terms of VCs. Everybody know each other, and if any one of them has had a bad experience with a similar industry, everybody tries to get put off with that. So that's another factor, that no matter how better you are, perhaps with your contemporaries or with the competition, still there is that bad taste in their mouth that really impacts your chances of getting the funding as well. And then the same issues as the Yusuf was saying, that they're not sure exactly when to jump in, and they have these promises. The last one I would mention here is something that you don't know who's the right guy to reach to from day one, because starting off with the executives that they have, initial discussions. Unfortunately, they are not very well versed with the industries that you are into. So they have more of a generic experience that makes it very difficult for them to understand that not one size fits all in terms of KPIs, in terms of business results that they are. So they have learned these jargons or these terminologies of startup, saying AOV, ARR, blah, 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 but it does not actually stands true for all types of businesses. So I think that is something that should look into, especially I'll refer to VCs, that they should have people, specialized people for specialized industries, because that's going to really help them to find the right startups and to shortlist the ones that really make sense for them as well. So these are my 2 cents.
Okay. Yeah. I mean, the trend chasing and the cool things, or they've done it before. There's the old saying of like, there's two reasons not to do something. It's never been done before, or it's already been done. So you can look at it from both ways, and you can kind of argue or think yourself into a situation of not doing any deal. All right, Abdul Latif, go.
Everyone had valid points. I'll say we feel the same. Maybe an extra on that is where you're actually building a new product. These investors kind of like the few conversations that I've had, they don't know what's the correct time to invest. And that confusion reaches to us. For example, some say, hey, we invest in pre-seed, we invest in the team and the product and X, Y, and Z, but that doesn't actually translate into action. And it leaves the person saying, hey, let's focus on building the product, leaving fundraising later. But we get the other advice, hey, start fundraising, talking to people from now. You don't want to wait too long and be desperate. So it's a bit of a balancing and I'll say mismatched expectations.
So what do you do in order to try and get more urgency
from investors?
Yeah.
I don't have an action plan in mind at the moment.
That's fine. I promise I won't tell any of them.
I'll say we close 80% from the round. Mr. Abdulrahman invested, and خلاص. We'll piggyback off of that.
All right. So we'll do the FOMO. We'll try to name drop a little bit. It's more common than you think. Abdullah, tell us. You're muted. You've unraised your hand. You're still muted.
Sorry. وعم بحكي كمان قاعد. So mainly it's the lead time. That's what we're facing. يعني we plan to start raising مثلا in January to close it by, let's say, 4 or 5 months. يعني the cycle time from agreeing to invest till the money is in the bank is always unclear. يعني based on our experience, we had that with one of our investors. The way that we pushed it faster was like all the other investors already transferred the money. You guys are the only ones left. And then they decided after a month or two. But it took them around, I think, 8 months for the complete cycle, which we felt is a little bit frustrating because you have all of your plans, your projections, and everything to have that money in the bank to start expanding, hiring, marketing, etc., and all of that. So it will push all your plans where the other investors won't be as happy because you're not achieving the results that you're supposed to achieve, although you don't have the money. So that's like a struggle that we're having.
Okay. So being able to get them to follow through, honor their commitments, and do so quickly enough so you're not left in this weird limbo where you can't apologize from those who want to invest. because you're worried that you might end up saying, "Hey, sorry, I can't have you in," and then uh, 3 weeks later, you're like, "Hey, are you still interested? I know I said no, but like, yeah, I hope you can find it in your heart to forgive me."
Yeah.
Okay, so we've got a couple of points. All right. So I want to jump into I want to categorize a couple of things. There's a lot of stuff that is about driving FOMO. How about negotiation? Uh, any challenges from people who are in the midst of negotiating deals? Do you find yourself kind of either it's a take it or leave it, this is the terms, these are the caps, or do you find that the
Yeah,
deals keep fluctuating?
yeah. Recently, I've been hearing that so like the valuation is high. So when the valuation is high, okay, I say, okay, tell me how you think and like walk me through your justified valuation thinking. And then they start saying, okay, this is how I look at it, and this is, and then I say, okay, how about this reference, and I see if we're really far, then I'm like, there's no point of negotiation. It's not gonna get anywhere close. If it's like there is some movement, then I go back and forth. But if I see just it's way off, then I just
So
don't continue.
what levers are you willing to move? Like maybe you don't want to trigger any kind of MFN clause, so there's only so much that you can play with evaluation. Um, what other levers do you move so that you can find a good common ground for the cap or for the actual valuation?
Usually, I don't give someone lower valuation than the previous investor. Never.
Yeah.
So if that's the red line for me. It's like if I face that, I just leave. I just say I'm sorry.
Do you find them negotiating for discount rates? I've noticed a lot of founders recently talking about discount rates.
I personally use more the cap. I
Mm.
haven't used a lot the discount rate, but just because it's easier. But
Yeah. No, I mean, I have a particular, like some of you guys have heard this from me. I have a distaste for founders like haggling over discount rates. It feels like a kicking an investor while he's down kind of deal. Like this is my downside protection. You really want to remove my downside protection? Like this is the most rudest thing you can do to me. But some other investors seem to be more forgiving. I don't know. Particularly angels seem very keen on discount rates, but like very rarely have I seen a fund do well because of a discount that they negotiated. All right, Raj, let's go.
Think there's a perception of everybody being in a weak, as a founder, being in a weaker negotiating position versus these big VCs with these big checks, etc. And I think we need to really get away from that mindset and really sort of understand the fundamentals and value of your business. And if they're crossing a number of red lines, you're not going to get the perfect deal, but if there's a number of red lines being crossed, one too many, then just be prepared to walk away, right? And rethink your strategy and rethink how you're going to approach the market. Maybe the kind of investor you've attracted with your strategy today isn't the right kind of investor, and maybe just take a step back and rethink how you approach the market rather than, I guess, accepting what could be a predatory term sheet from a founder given the kind of terms that it's bring forward.
Okay. Yeah, it does feel like they have more information. They do this every day. This is their daily life. Whereas you, as a founder, are fundraising in a few key time periods during the life of your journey. So, plus they feel less time pressure than you do. So it does feel like you're always kind of jumping through hoops versus they're always kind of relaxed and willing to take their time. It does feel a bit rough. Safe. What's your gripes? What grinds your gears? I can't hear you. I see the lips moving and I don't see the mute sign.
Now, can you hear
Yes.
me? Yeah. So from my experience, honestly, it's always extremely difficult at the very start of raising the round. Like when you don't have anyone who's committed, that is the hardest thing for a person. But by the end of it, it becomes much, much easier from that aspect. Now, when it comes to negotiation, I'm lucky to have an investor that has an MFN clause. Basically, they will take the best deal um, after they sign, which means that it's a good excuse for the other investors when they start negotiating about the valuation. But that is from one aspect. The other aspect is,
So let me
and I
see if
think
I
that was
understand this correctly. Like you are happy that you have an MFN clause because if any other investor wants to get like a sweetheart deal, you say this is mutually assured destruction, that investor will never waive their clause, and as a result, I cannot really give you
well,
uh
it's not mutually destruction, but because at this stage of me raising that round, I'm actually in a good position. We're not here talking about I'm running out of money. I'm like 10 minutes from
that
bankruptcy.
has nothing to do with MFNs. I'm trying to understand how an MFN is helping you during the negotiation.
It just allows me to avoid that conversation to begin with, which is like I I know it's not the best situation, but at least I have this, so I can avoid it. But the real convincing happens where it's by understanding where you want to actually reach by the next round and the one after it. So when they say, okay, say if your valuation of, let's assume $6 million is much above the average of a pre-seed round in this region. We're talking about 3 million typically and so on. And there I go and tell them we're at an AI space where the average is blah, 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 blah. Now that is okay, we can go and find a few comparables where we say those are who raised and so on, but that's typically is not good enough. For an investor, he would like to know where are you planning to reach for him to justify this pricing. And that's where, for us, we talk about what is our next valuation and how much will it be and how many X's it is from the current one and so on. And for him, it says, okay, this makes sense. And the conversation shifts toward will you be able to reach that valuation?
Okay. And finally, Abdul Latif.
Um, Sorry. Yeah, so one last bit I wanted to add is when you get few investors committed that you personally don't know and you ask around, you get some nightmare cases with some of the founders. How do you actually find out if this was like a misunderstanding? It happened once. It's not the like
I don't think I fully got it. Can you rephrase?
basically, if you don't know the investor very well, you don't have a personal relationship with before or a professional one, and you go ask around from one of the founders and they say that they had a bad experience with this person or like a predatory action or something. Like, how do you actually investigate that if it was a one-time thing or if it's a common thing? And also, on the last thing Seth said, the interesting part is when you discuss the next round that you're going to raise at what valuation, like how can you determine that early on? Is it like growth forecasting? Like how can you actually predict that? And some people do, because I can like put charts and data and like we're going to be this X. Like how can you actually do that?
Okay. So how to DD investors is point one. And then point two is how do I plan for the next raise? Structuring the next raise when I haven't done the first. All right. We'll cover all of these points. Okay, so I see a lot of things that talk about the need to drive action, the need to create FOMO, and the ability to get past the first stage of the fundraise, which feels like the hardest points because you inevitably get the question of, do you have any commits? And every founder answers that's just starting out answers the same. No, we just started. No, we just started. No, we just started. Even those that actually started months ago will keep saying, no, we just started because it's the only answer they can really feel comfortable saying. And maybe I see this more than others because I'm present in a lot of different locations, so I do see them pitching in different areas. I do see like the terms changing with time. I'm seeing the size of the round fluctuating, and I try to keep tabs on what's been happening. Not that every raise is effortless, but I do try to understand the logic behind it. Because I've seen a company tell me, oh, we're oversubscribed. And then like 3 months later, they're still raising. It's like, wait, but what's the deal? Like, why are you raising? Why are you here? Why are you even on the stage? And oh, well, we're thinking of extending the round. Like, all right, like clearly there's some games being played. And it appears a lot clearer once we ask for legal DD, all previous signed notes, and suddenly you get a much different picture. So here's what I would recommend to all of you starting your raise. There's two mentalities. There is the always be raising. I'm going to meet an investor at this event, at this dinner, versus the structured raise, which is I will dedicate these next 2-3 months to focus myself on raising, and the rest of my team is going to focus on running the business. All of my day and night will be obsessed over getting this round done. Once it's done, I can get back to the actual important business of running the business. I tend to prefer the second approach. Now, I'm not saying I haven't met successful founders who are always raising, but the reason I prefer the second approach is because you kind of fall in the situation where, let's say you meet somebody and they're kind of in the lower end of your ideal investor list. And you get terms that are not exactly what you wanted, but they're survivable. And you have another meeting with the VC you really want, or the investor you really want, who would drive good signaling, and we're in DD, conversations are going well, and you're kind of in this, do I take the sure thing that is or do I wait until I get the best thing, which could be transformative to the company? It's the kind of stuff that keeps founders up at night, keeps you arguing with your co-founders. It's hard to make that decision fully satisfied. And the only way to not fall into that loop is to get all the offers at the same time. Now, getting offers from VCs is not too dissimilar than herding cats. And how can I make sure that all VCs give me offers at the same time? What's the trick? How can I get them all to send me offers at once? Do I run an auction?
So run a process, but then
Exclusively on what?
My
don't
question
set
is,
time
have you
frames.
seen it? Have you seen it?
I've seen it in a very few cases. And usually it's when a founder is maniacal around the raise and actually like legit religiously runs through it. There are very few times I've seen a founder like show me the process, and like we walk through their sheets, and you can see every single investor conversation, timestamped notes. This is meeting number X, this is meeting number Y, and it's a thing of beauty to kind of see that. They still get lots of no's, they still get lots of rejections, they'll still have the same meetings as you guys, but the main key difference is when that switch flips from a round that has a lot of interest, suddenly you see like people fighting to get it. The only way to make sure that you can get a lot of offers at the same time, let's say I get a founder and he comes to me, he's like, look, man, I have an offer from Impact. Nice to meet you, Abdulrahman, by the way. I know we've never met before, but I have 1 week to respond to their offer. If you want to invest, you'd better run your DD, do everything you need to, and decide within a week. In those cases, it's an automatic no. Like, I can't shift all of the ICs, everything, just because this founder got an exploding offer. It's not good discipline, and when if FOMO and if this is the way that they expect partners to come on board, then it kind of sends all sorts of red flags. But if you start the process with everybody at the same time, and you do that by not asking for meetings day one. oh, let's meet next week. No, no, no. All meetings happen from a month ahead. People's calendars are still relatively clear. You can make sure that you've got like meeting after meeting after meeting kind of lined up, and you can start the process with all of them. That way, when you do get an offer, you're able to say, hey, like, I know you're still looking through the DD and you're still analyzing it, but, you know, I'd love to work with you, but we do have an offer and we will need to reply within the next week. They've already spent time. They've already met you. They've already done some initial analysis. This will light a fire under their team to get this through the door. And that's the way you can actually drive realistic, respectful FOMO. So a lot of the problems that we feel on the negotiating side happen just because we didn't really start it structured. We don't have the conversations happening at the same time. And I can't use a sheet from somebody because we just didn't start the conversation. So start in parallel would be the key thing that I think makes a huge difference. I think the person who ran this process most tightly as of late was Yazid from Ijari. He did, like, I think he had a list of, I think it was over 111 something investors that he actually walked through every single outreach, every single communication, every single meeting. And the ones who did not respond within a week, he'd have a call with myself and Amal just to review, like, hey, can you ping this person, ping that person, ping that person? That we haven't heard back, we haven't heard back, we haven't heard back. Even if it was a no, he could at least mark it as a no. And the other reason fundraising is so annoying is because sometimes you guys don't want to hear no, and you do everything impossible to keep the ball in play. So I'm not sure. You can tell that it's a no, but instead of kind of shutting the door and focusing energy elsewhere, there's especially first-time founders who this is maybe their first or second raise. They feel that sense of, no, there's hope, there's hope, there's hope. I can convince them, I can change them. Energy much better channeled elsewhere. So that is something that you guys would need to do before the raise. Now, most of you have lists of investors. You have an Excel sheet and you've got your target list. You've got your most important investors on the top. You've got some people in the middle, and you've got some less fortunate people down the bottom. And then you've got maybe a few names that you would never take money from and would rather donate your kidney than take money from them. Okay, good. The problem is you typically start where? Who do I talk to in the list? Who do I start pitching?
I think with the least, not the most.
Yes,
Keep
from the bottom.
Start with the least.
with the last.
Good. So you
Yeah.
start with the ones you
أحرق
think the least.
الأول طبعاً.
Hmm?
I'm saying burn the cards for the lousy ones. They'll ask you the hard questions. You'll not be that prepared. So it doesn't really matter if they
Well,
get a
this
good
is
impression.
great. So this is a really common question. Sorry, this is a really common answer from founders where they're like, you know what, Abdulrahman
Yeah.
thinks I'm going to say the top. So I'm going to say the ones I like the least because I'm going to learn how to pitch and then I'm going to start the top. I actually recommend to not pitch to investors for feedback. So if you, because we just said two things, right? We just said that investors are lousy at giving feedback. They don't give you actionable feedback. They give you fuzzy stuff about, oh, I'm not sure about the market. I'm not sure about the model. I'm not sure about traction. So you don't really get anything that you can use. And if they're really lousy VCs, then it's even like really lousy feedback that you might not react to as much. So not bad. I'm glad you kind of thought through. Abdulatif, do you have another answer?
No, I actually wanted to ask. Like, it feels very weird. Some people are taking it like to impress people. Is it bad if I just go to a VC, talk with them, take them through a thought process, thesis, product, everything, and ask feedback, like genuine feedback? Is that bad, or should I practice more? Should we go like on our A game and just like, yeah?
So you can ask for feedback. It's just most VCs who have given feedback have regretted it. Okay? Founders don't want to hear no. And the moment you tell them why you're not interested, they want to convince you otherwise. It's an exhausting process. It doesn't pay you anything back. It just serves to have somebody frustrated at you. Now, I'm not saying that's you guys, but this is an aggregate. Like VCs don't just talk to you, they talk to everybody. And unfortunately, there are people who every year will send me like really nice Twitter messages of like why I'm such an idiot, why they're going to be a billionaire, and I am not, my IQ is not high enough to invest in their company. It's like, all right, I'm gonna have to like take my pills with everybody else. But if you want good feedback in the beginning of your raise and you want to make sure that you're somewhat in the realm of reality, pitch to founders that are either one step or two steps ahead of you. So if you're raising a seed, pitch to a founder who just raised an A, maybe a bridge, right? That helps you do a few things. First of all, if your pricing is way out of whack, you'll get a gut check. Investors talk to each other. This helps you kind of get feedback and cut through that process. Sometimes those founders might write an angel check. And if it's somebody in your sector, that could be a good name to have in your cap table and build credibility. Other VCs that know that founder will recognize, oh, person A put some money in. They put like a 25 or something. Let me talk to them about why they did that, why they liked the deal. So start with founders a few steps ahead. It will give you much better feedback, and sometimes you'll get a great angel. Okay? Then you can start with the middle and kind of work your way up to the top. That way, as you're pitching, as you're getting your questions, as you're increasing like some of the files in your data room, you're getting more and more practice. You work your way up. You work your way up to the top, because obviously your worst pitch is going to be your first pitch. So you can end up kind of improving, and getting there until when you talk to your most treasured ideal partners, you've already got commitments, got some pre-approval, and got your A game to when you're talking to them. And yes, it's like high school when a guy likes a girl. Yeah, always. It's human nature, herd mentality, safety numbers. It all triggers. The thing is, like, everybody tries to instigate FOMO, but a lot of the people that do it unsuccessfully, like, I'm so used to like getting these flags of FOMO that they're cliches and almost turnoffs at some point, because the founder just doesn't respect like the basic like understanding of, like, I had a founder who basically said, oh, X investor is leading my round, and they gave me a 500K allocation. Like, it was just like, as soon as the call was done, pick up the phone. Hey, like, I hear you're leading that deal. What do you like? What do you think of their timeline to expand to Saudi? And they're like, oh, no. We never made any commitment. We met them once. We still haven't scheduled them for IC. We haven't even closed our second fund, so that's why we can't really deploy. Like, oh, okay, good to know. This person is willing to lie. And like, we confirmed like multiple times. I checked the recording. I was like, yeah, they're leading. Yeah, they're leading. Yeah, they're leading. And I was like, all right. I've had companies lie about their customers, even when I make it clear that I know the company who they're talking to. So another way to kind of shortcut trust and get into VCs is if you're selling to any of their portcos. So there are many deals I've done because when I called some of our own founders, I'm like, hey, have you used this product? I saw your logo in one of their slides. Like, oh, yes, incredible, loved it. It's like, all right, great. I've got like good customer testimonials from people on the ground. That's a fast way to help me kind of do DD, but it also works in the reverse. I had one company who had never, like, I made it clear, like, oh, like, I see X's logo there. They're one of our companies in the previous fund. They're very big. Like, yeah, we know them very well, and we're excited about working with them. And then we pick up, call the founder. He's like, oh, I don't know. I'll call the team. And then the team comes back to us like, oh, we met them twice. We have no interest in using it. We think it's too expensive. And that's it. So a lot of people shoot themselves in the foot unnecessarily. But if you do want to shortcut specific investors, one underused tactic is to actually sell to their portcos. Like that goes a long way. I don't know why I don't see more of it here in the region. Everybody goes for referrals from founders. That's nice. I've gotten some great companies through referrals from founders that I've invested in and backed. But when the founder has used the product, that is such a much higher level of affirmation. So all of these things will help you kind of break through and get to the trust. If you get there, the negotiation piece is easier. Like the during phase of running the process is probably one of the easier things if you've gotten all of your kind of your deal structured. Now, some of you will handle the discussion piece in an unfortunate manner. And I've been in this situation where I'm in a call with Uqal and I see one of the companies I've invested in join the call and handle questions in an unfortunate way. Like they dodge competition questions, they dodge valuation questions. Like I said, one company like say, oh, why is the valuation this much? I was like, oh, 500 priced it like this. Like, and as soon as they left the room, all the angels look at me and they're like, what's the deal? Like, no, I did not set this valuation, guys. Like, I don't set anybody's valuation. I'm not going to sit down and decide for them what the terms are. So it puts your investors in an unfortunate position. I'd love to kind of help. I'd love to be a voice of confidence, but instead we get stuck in a rut. So those are some of the key mistakes that happen. I want to also look at the points. Yeah. So a couple of other points. My investors have bad memories or trauma from a category. Every player in that category they consider scary. And these two are kind of related. And point B is investors don't have the requisite specialization or skill set in my field. So how can I get them to buy in? There's a couple of thoughts. So the people who struggle the most with the lack of specialization are probably crypto and deep tech. And then a couple of other boutique sectors. So if you look at education, health especially, those are ones that investors are very, very scared of for good reason. So in those kinds of sectors, it's really tough to get investors to come on board. And the only effective way I found for cutting through that is to actually figure out who are the people who have the most knowledge and the most respectability in that skill set, even angels. Like if you just get like one key angel, for example, I had one company who was in the e-commerce space and they had Mazen al-Darrab as an angel. So, you see that you're like, okay, Mazen has seen e-commerce from its inception. If he's invested, odds are like he sees something there, and maybe it's worth a deeper look from a technical perspective. So figure out who that first mover is, who writes that first check. There are funds that I'll tell you like, oh no, don't bother like with them as the first port of call because they'll only follow on. They never write the first check. They never lead the round. They never set the terms. So each one has a particular category. And there are some categories where they're willing to lead. So for example, if we look at Wa'id, there are lots of deals where Wa'id will never lead. There's a few that are highly strategic where you could see them like, they'll come in, they might cause other problems like overvaluing the deal. But at the very least, you got to commit. You have an investor and they're willing to write that first check. Now, how do we DD investors? How do I pick which person to talk to? How do I make sure that these investors are solid people who won't screw me in the long term? What do we do?
So Abdulrahman, before that, can we prevent a toxic investor from screwing us, even if he comes into the round?
It depends.
And then how do you do? So like there's two sides of it. Once we're stuck with the toxic one, or let's say before even him signing that term sheet or whatever.
All right. So you want to eject the toxins, right? Or you want to neutralize them. You want him to be in the deal. You know he's bad news, and you don't want, and you want to minimize.
Maybe, yeah. Let's assume.
Okay. Look,
I'd
I'll
like to
tell you that if you know an investor is bad juju and this is not company killing, not to raise, I'd rather you don't take the money. There are some people where if I see the name on the cap table, the deal is like 100 times less appealing just because I don't want the association. I don't want to deal with this drama. I don't want to get in these kinds of discussions. I won't tell a founder, don't do the deal with this person, but I will sometimes warn a founder to hire a really good lawyer to screen through every single deal, even if they tell you it's a standard safe.
My question for you, Abdulrahman, here is this applicable for all stages, or the damage in pre-seed and seed is much lower than, let's assume, Series A, Series B?
If we're talking about Series B and C, you have less applicable investors. You are not able to pick and choose who you want to work with. So those are the cases where you can get that round done, get it done, and you will not have the most pleasant conversations with their armies of analysts and lawyers, just because there's less options. When we're talking pre-seed all the way to A, there's usually multiple options available. And those that are continuing to be active in the market are usually the ones who have exhibited good behavior, have good reputations with founders. But there are rarely like I've had one founder who, while he was fundraising from one specific VC, he asked for reference checks from other founders, and the VC gave him like two founders he could talk to, and both founders said, "Run away, don't take his money." Like it took him 7 months to wire us. It was painful as hell. He haggled the price down, and ultimately, it was it was almost company killing how slow it took for the money to hit our bank account. And those were his references. Like it's not like maybe he just wasn't expecting the person to call. Maybe he didn't realize he'd affected the company that much. But sometimes it's as obvious as asking for a reference. Most of the time, you can get back channeled, so you can talk to the other companies that they've worked with, that they've invested, the companies that have struggled. You can easily get a good reference check. I try not to do like whenever a founder asks me like, oh, like, why should I take you versus X investor? It's like, don't listen to me. Like, talk to any founder. Like, ask for somebody's contact. I'll furnish it. I'm a little bit biased. I do think I'm awesome, so won't help you to talk to me.
Would you say that failure to provide a reference is a red flag?
Yes. It's like the easiest thing here. Like, and even like LPs ask time. Like LPs will always ask when you're raising for references to founders.
So they can't cite confidentiality and that sort of stuff. It's
You're just asking to talk to another founder who doesn't hate you. Like, is that so hard? Like, maybe if this is a fund that you just started, you haven't deployed, but still, like, you should have some relationship, some access, some know-how. If you can't tell me like you have one founder who thinks you're a nice person, it's a bit of a red flag. Yeah. Like there are nasty VCs who will be able to at least give you one or two founders that do like them.
So you mentioned something related to the safe and letting the lawyer review them and everything. How common is it that a VC will refuse to sign your normal safe agreement? I think that's an interesting thing. I'm assuming with 500 startups, for example, you have your own version, but is this applicable to all VCs?
We've done safes. I think the only thing that we add, if we're either the main difference from a safe or a KISS is the information rights. So we do add information rights because we need to send reports to our LPs. So that's the main thing that we focus on. So in that case, yes, you need to have a structured uh, report that you're sending to your investors. I would say that maybe there's 2 VCs recently that have not signed a safe, and that have asked for it to be amended, but it's very rare. But if you are given a safe from an investor, like that's the thing that gives me a red flag, where an investor says, hey, don't worry about this. Um, I'll help you. I'll give you the safe. I'll introduce you to other investors. I'll bring some other people along. I'll structure everything. I'll handle you, founder. It's okay. Like, take a step, take a chill. Let me handle it for you. And that's the most seductive thing you can say to a founder. Like, hey, don't worry about this raise. I got it. And it's like, no, man. Like, come on. This is your job. This is your responsibility. You're supposed to build these relationships with these investors. And if you have no control over it, like, how are these other angels or other investors okay investing in a founder they haven't met? So usually there's some weird stuff happening. So sometimes you'll find that like the person you're talking to is investing at a cap, but is giving it to other people at a higher cap. And then you notice you've got these weird agreements that like are embedded bombs within your cap table. And it's just because you decided to say, you know what, I'd love to have somebody, like he says, he knows everybody, he's so well connected. I'd love to have him take care of it. Okay.
Clear.
All right. A few points. So somebody brought up after raising and having people wire the money. I have a couple of investors, a group. Some people wired, some people didn't. How can I tactfully ask them to put the money in the bank? What have you guys done?
So typically, the moment that they sign the safe, I send them the email with the agreement and tell them we have like 2 weeks. We're expecting that transfer to happen, something like that. So we give them a timeline for it.
Okay. You gave them the timeline. Timeline passed. What happens then?
Then I nag the hell out of them. But in reality, for me, so we had someone who did this and we just discarded him.
How long did it take for you to reach that decision?
I think around a month.
Okay. 1 month.
The deadline. Yeah, after the deadline.
1 month after deadline. And then what? Did you get another investor to replace them, or did you just say, all right, you know what, we're not going to close the full round?
No, we actually did.
Okay. Nice.
Yeah.
Tasfiya?
So now, which makes it very interesting because this takes me to the other question. Should we always aim to be oversubscribed for such situations?
Should you be oversubscribed? Well, not really. There's good ways to do follow-up, but I do recommend that you never close the round until everything hits the bank. Even funds like fund managers are always nervous about making sure that their LPs and their investors and their funds are actually there, actually legit, actually closing. Tasfi, I see you've got your hand up.
Yeah, hi. So my perspective, what I did, I don't want to make my hands dirty. That's one thing. So I'm a founder. I need to keep good relationship with my VCs and other people. So dirty work, I let my lawyer do that. So first step, what I did, like I told my lawyer to talk with, not directly with the VC, but their lawyer in terms of like, hey, like there was a written timeline for 15 days, it's crossing, what's up? And eventually, like second or third step, it was not necessary. When the VC got a email from their lawyer, it was eventually disbursed in our bank account. But I initially planned with my lawyer, it like first step, you reach out to their lawyer. Second step, you reach out to the VC. And third step, like, like demand later and like what's not, like, like keeping and keep pushing them. So, but from my end, I personally didn't do any kind of push because like I feel personal relationship, keeping it intact is very important. And that's why I hired lawyer in the first place.
What if it's an angel? They have no lawyer.
Most of the, so actually I don't, I'm not that much aligned with the angel checks. And I can tell from personal experience, all the angels that I have had so far, most of them actually gave me instant checks so far, all of them. Within like, it was highest like 7 days for one of my angel because he was traveling. Because most of the angels who have been part of our journey, like they have kind of like now become a buddy and like early advisor, and they have been helping us in terms of all the step of our company. So
Good.
yeah.
Well done. So yeah, there's a couple of different things that you can do. If they're investors, if they're VCs, and you want to apply pressure, there's two like calmer ways to do it that won't get your hand dirty. One is to have your existing investors talk to them. So I've had one of the there was a founder who was raving about this VC because like when the round was closed, he asked them like who did not wire the money, and he personally picked up the phone. He's like, Fulan, like what's the holdup? Are you we want to close this one. Are you okay? Everything's now when they feel that their reputation amongst other investors is slow, it gets them to act a lot faster. They feel the sense of embarrassment, and it gets them to move ASAP. So that's one that you can do if they're especially non-communicative and slow. Another one is to kind of drive it's more effective with angels. I had one founder who, in a similar situation, I was traveling and he just sent me this message of, hey Abdulrahman, I've got I want to honor my commitment to give you this allocation, but I am running short of space, and I do have some angels who are interested. If you're not going to be deploying, can you please just let me know, because they'd love to get in. Very respectful, very clear timeline, 1 week, etc. It was a good model to follow. There's no need for the WhatsApp of like ... Hey, when's the money gonna come in? Hey, like no, it was very clean, and it didn't feel very naggy. And that's what I think a lot of you guys struggle with. Saad, I saw your hand was up momentarily. Why? Or I'll come to you.
Yes, yes. Thank you, Abdulrahman. We have been in a similar situation before. After we closing the pre-seed round, mostly it was an angel investors. After we sign agreements also, one of the investors, they didn't wire the money. Uh, in that situation, it's difficult in the situation because خلاص, we finalized, and most of the investors wired the money, everything is done. After a while, and as you said, one of the investors said to me, "Why you didn't tell me? I want to invest more in your company." They said, they said to me like that. It said, "Why, really? Why I'm not do that in that time?" For this is something important, and you're existing investor because they're already believing in you. For if they didn't wire the money, then you can't to speak to the same investor that you have already done with them. Just I
Yeah.
want to mention.
So in that case, yes, you can just say like, guys, we have one investor who pulled out. We have X amount of extra allocation. If you guys want it, great. If not, then we're gonna shop it around for new investors. That's something that you can do. Try to keep it brief. I've had one scenario where if you're like, some of you will have transactions in the future that will include like secondaries and selling some stock to investors as well as letting new people in. I've had one case where like this caused up a serious amount of drama between the board. One of the board members bought some secondaries from one of the founders who was getting married and wanted a little bit of extra cash just to get things set up. That caused so much consternation, like to the extent that one of them just left the board because he didn't like how he was being portrayed. And the founder, like, he thought, oh, you know, this person is willing to buy some of these equities, really nice of him. Didn't realize that if there's something that's going to be sold, secondaries, everybody needs to be made aware at what price, properly governed. But, you know, if this is your first raise, you might not understand it. And unfortunately, in that case, like, the board members were all very senior, all very proud. So it was difficult for him to repair the dynamics. He just had to have that person leave the board and deal with the fallout after. So be very, very, very careful whenever there's secondaries involved. The other element is sometimes investors will try to use secondaries and buyouts as a sweetheart thing to win the deal. So, hey, like, I want to invest, and if you let me invest, I'll also buy secondaries at this price. So it's kind of like an immediate cash out. It's not, I don't want to use the word bribe, but it is pretty adjacent of, even if it's a lower valuation, like, here, you know, you get some cash now, you can get a car, you don't feel, you know, stressed.
So the issue was it was a lower valuation, يعني? No,
yes,
okay.
it was a worse deal. So it puts me in an awkward position. Like,
Yeah.
I know the company can fetch a higher price, but the founder, the co-founder, all of them want this deal desperately. The other investors are kind of begrudgingly because letting it go through. And it's one of the few cases where our interests are not aligned. I know that they could have easily, like, increased the sale price by an additional 40%.
Oh,
But just because they saw, like, a
quick.
couple of million reals right in front of them that they could take today, and, like, I wasn't even supposed to know. Like, I did my homework on the deal structure and everything, and but it does put you in either you are the sole person willing to stand in front of this deal, block this founder, or you let it go by and accept a weaker return and a weaker multiple. So in those cases, you test for founder mettle and strength and their ability to resist the temptation. Nabil, go ahead.
Hi, Abdulrahman. We went through situation. I just want to see whether if we came again across it, what we're supposed to deal with it. We were not raising fund, okay. Some investors they approached us. We said we are not raising right now, but we are going to raise later. Then they went and approached some of our existing investors, and they talked to us. Can we sell them our share? We said okay, it's fine. They offered them maybe 3x or something, and they bought it. Now we said it's okay. We don't have any problem. But since we are not raising funds, so that's the thing. So if you were in the same situation, what will be the act, or is it that fine that okay, it's good that they have benefited the previous investor, yet for us we did not benefit anything.
In this story, how far were you from raising?
It was maybe another 1 year, maybe.
Okay.
Like
So
8 months to 1 year, something.
this situation sometimes happens. It happens in two flavors. The one you just described, the other is when you're raising and you get super oversubscribed. So some of you who have announced closing a round, like maybe you have your post on LinkedIn, on Magnet, the moment you announce that, hey, we closed the round, we have like 2 million, yay, your DMs, your WhatsApp gets flooded with people. Hey, is it really closed? Is it really closed? Can I invest? Can I invest? The moment you say you don't want money is the moment everybody chases you to give you money. And then you're kind of stuck in this position of like, should I take some extra buffer? Should I take the cash?
That is the thing, yeah. This is exactly.
So you kind of fall in this scenario. There's two ways to handle it. What I would typically try to do if somebody really wanted to get in is I would consider what the next round valuation is going to be and get them in at a higher discount.
Okay.
So we're going to be raising in a year from now.
Yeah.
At a 12 mil, but would love to have you in at that raise. We'll give you an MFN and a 30% discount just to protect your downside. If you really want to lock it in, we'll happily do that from now.
Good idea.
So that would allow you to get the money in the company. When you raise your next round, like maybe like 20% of it is already closed. So you start without a zero, you start at 20. So that's a nice position to be in.
Yeah, very good. I
you
like
do
your
that,
answer. Yeah.
That's how I'd approach it because that's money in the company.
Yeah, exactly, because losing it all and like
Yeah.
okay, and the investor was okay,
let's say you're
happily
feeling,
saying in the conferences I got 3x from them, and you know, where
let's say you are feeling generous.
sometimes later you are okay regretting whether did I make the right decision, not. At the same time, we just don't want to just collect money and it is out of our plan. And Abdulrahman, we are going with the same policy, like we open and that's okay. Now we are open. Once we are closed, so we don't very much entertain. So,
So I'm not telling you not to entertain.
no, but this is not the issue. Yeah,
you can take that energy and store it in your battery for the next race.
For the next one, yeah.
I try not
Makes
like
sense.
business is very rarely like black and white, very rarely perfect. You guys won't be able to like comfortably decide, do I not want, right? I'm telling you what works, but there are these edge cases how you can plan around it.
Yeah.
Now, let's say you are feeling particularly generous. Somebody does want to have a higher ownership in your company. And even if you did this, you can't get them to their target ownership. In that case, you, not them, you send a message to all of your investors saying, hey, we do have a secondary sale option at this price. All early stage investors who want to exit, please send me an email. It has to happen through you, Nabil. It cannot happen as investors talking to each other.
Yeah.
Because then you'll get into the same drama as the guy who the founder who sold his equity.
Yeah. Very good. Yeah, I like it.
Okay.
Thank you very much, Abdulrahman. This is the best answer I got. Like I was always confused about this situation, and I did not ask it. But
so the reason this is so important is because if you don't do this, if you don't take charge of the process, they'll feel that whichever investor has the tightest relationship with you will get preferential treatment and exits, and those who don't will get forgotten. So that's not a good culture to kind of seep in. Make sure you're taking charge. You don't have to do this. I had one founder, a company I did not invest in, but the founder is a dear friend, where he had one family office that invested, and there was some like drama within the family, and they had to like liquidate their position. He actually spent a month looking for people to buy out their shares because they needed to disentangle some of the family assets because of some legal issues. So that is above and beyond.
Yeah.
I'm sure they really appreciate it. I'm sure they greatly value that he was able to kind of liquidate that position for them. But that's another kind of situation that you might find yourself in, especially if you've got a family office investing.
Yeah, I like the idea of like we lead it. However, we try to take the opinion of the board, which is led by one of them, but that was the thing. But it's taking the lead is good, yeah. And
yeah, you have to send a message. You have to send the message.
Yeah.
This is
professionally that this is the way it goes for all. This is how it is.
Please respond by this date because then you're gonna hand it over to these guys. Because like from a governance perspective, you could be liable if you don't do this way.
Okay. Good to know. Thank you, Abdulrahman.
Safe, what's up?
Sorry, I'm asking a lot of questions. So you mentioned that there are two approaches, always raising and the timed one. I'd like us to shift to the always raising. How does that work? Does that mean that I'm able to raise across 24 months at different valuations, or how does that work from your perspective?
Rakesh, I see your hand is up. You want to add?
I got a question. I got a question after Safe's question. Sorry,
okay,
I was doing that because I couldn't find the button to actually raise my hand, so I have to hold it up for a certain amount of time. Sorry.
I thought we were going low tech. All right. So if you're always raising, yes, you can change the valuation, but don't change it too much. The founders that are always raising, they've got like, it's almost like every year they have like a sense for what they're at. If I do DD and I ask for every single sign safe, and I find that the price fluctuates from month to month, from investor to investor, high, low, high, low, high, low, it's a really negative signal, and I will not fully be comfortable with this founder. Because
What do you mean by high, low, high, low?
So-
Does it mean
Oh,
it
this
goes up and
investor is really well connected. He owns this hospital, and therefore I'm going to give him a sweetheart deal. And then this other investor that invested the month before has a higher cap. So like it tends to be like based on negotiation and based on the founder's relationship and their perception of the investor.
what
So-
if it just increases?
Okay, if it keeps increases, it depends on the period of time between increases and the logic behind the increases. So if there was 1 month between the cap doubling and they didn't sign a deal with like the biggest hospital group in the country, I'm gonna need a much better justification for why this cap shot up, other than that they could trick this investor with this deal.
And again, I'm asking a lot of questions. I'm really sorry about that. But let's assume in a situation where someone undervalued his startup. I said, okay, my valuation for the first attempt of raising with angel investors is 1 million. And then he realizes that he screwed up his valuation and he accepted a few, got the ball rolling. And then he said, okay, now I'm worth 3 million. Is that a bad indicator? Is that healthy? What is your opinion in it?
If the cap table, like if we're talking about like a small amount was sold very, very cheaply to like friends and family, the ideal solution is to go back and recap and renegotiate and fix them. These are uncomfortable conversations to have. I had a founder who his brother put in the first, I think like a 200K check and owned half the company. Like,
Okay.
this is his brother who believed in him. There was nothing but a pitch deck. And he's like, no, he helped me. And then here I am saying, can you tell your brother to give almost like 40% of his equity back, because this is deadly. And you know, if he cares about you and about the company in the long term, then this makes sense. Oh, I had the idea. Oh, I did this. Like, I think the main reason we get cap table problems, and I just had this like 2 days ago, sitting with a founder who had two co-founders leave, and each one of them had like 4%. So total 8%. And I stayed for a good, like, he perceived it as like, what are you making a big deal about 8%, Abdulrahman? And yeah, like, could he raise? Yes, he could technically raise in the future with an 8% dilution. That's 8% debt equity. But the best chance he has at actually correcting this is now. The more valuable the company gets, the harder it is to fix the cap table. And the more valuable it seems, and the tighter they'll hold on to every piece of equity they own. The earlier you cut, the better. So have the uncomfortable conversation. There have been many deals that, you know, the fundraise was the impetus to get people to negotiate. So we have 3 investors, but they're all concerned about the cap table, and unless you guys reduce your ownership, it's not going to happen. And I've had 3 deals where even though like I invested as 500, the founder ended up owning more of the company after I invested than before. Just because I sat down with some of the early angels, sat down on the board. I'm like, thank you guys for believing in this for 6 years. But at this level of dilution, they're never going to raise an A round. I'm willing to do fresh capital in, and I'm willing to work on this, but if you guys don't let it go, then it's already dead on arrival, and I don't really want to do this. There has been like, I think 2 times where, no amount of convincing worked, and we just had to walk away. It wasn't for lack of trying. And cap tables are getting worse, not better. Like, because it's so bad these days with venture builders, I actually spend my initial conversation, I don't even ask about the product. I just look through the cap table, work through the cap table, and then I can actually decide if it's worth taking a deeper look at everything else.
And
Go ahead, Sif.
No. Let's Prakash, because I think this is a bit of a different question.
Okay.
So just so everybody else, Abdulrahman helped us with this very same issue about sorting out our cap table, and his advice was fantastic. It made the conversation with one of our early co-founders so much easier, right? And to do, we were Raj and I we were dreading the conversation actually, because we were like, you believed in us when we were nothing. You put in all of this money. How are we going to take this percentage away from you, right? But some of the points that you just made, Abdulrahman, really helped us. And so anybody else on the call, we're happy to share that experience if you want to have a chat about it as well. And it is the right thing to do for the business going forward. Absolutely, we see that, and I think it makes us stronger for the future, right? Not just for the future round, but also for even in the current space. So since that conversation, Abdulrahman, he's actually now been more active in what he needs to do as well, right? He's starting to make introductions and do things which we were struggling to get him to do beforehand as well. So it actually improves behaviors. So that's not the point I wanted to make. Wanted to ask about, but I just wanted to let everybody else know.
Thank you for sharing. I appreciate that.
So in terms of Raj, I think two of our investors have basically mentioned, one of them really strongly said to us that why don't you raise as much as you possibly can, so much so that you don't have to raise again. And then we were like, oh, what about dilution and all of this stuff? And he says, okay, just put the valuation up. And like kind of took us aback a little bit. I was like, can we do that? Is that possible to do? I thought like all of this got to be balanced, it's got to be benchmarked and all of this stuff. And he was like, no, look, he goes, is like, why do you have to be in a, and this goes to the previous point about whether you're constantly raising or you raise in discrete. And the point that he was making basically is that, okay, if you've got an idea of how much you want to raise over time or whatever, and you can raise or potentially raise all of that now and then do away, because obviously raising is takes away time from your business, and if you can get people to believe in you now and convince them on that, obviously there's a lot of convincing to do. I just want you to get your take on it, because we had one investor who was really strong about this and another one that implied this, right? And we'd never even thought about it from this perspective. We always said, you have a career path when you're in a professional, and you say, okay, you do this and you do this and do this and you get promotion. And that's the kind of way that you see raising money, right? You do seed and pre-series A and series A, series B, series C. So I just wanted to get your thought on it.
It kind of reminds me, one of the worst sentences that founders think are very clever that I physically recoil from when a founder says it is, after this round, we'll never need to raise again. It's like, all right, I've yet to see the company where the company gets bigger and their aspirations don't get bigger. It basically tells me that you're building a lifestyle business, and once you break even, you're good. So I should probably never invest in you. Or you're so naive that you think like marketplaces are easy, like money printing machines, and you think, oh, I could get a commission. It's very easy. Like, so that sentence should never leave any of your lips whenever you talk to any investor. If you think this is FOMO, this is your only chance to get in, there's never going to be a round after, please reconsider. The way I would approach this is it's similar to the advice I gave before about considering it part of the next round. I don't like raising more money than is needed because it sets a really terrible culture within the company of spending. That discipline is gone. Now, if they're willing to deploy part of your next round and you're willing to take it and kind of try not to dip into it, and you've got the discipline to say, like, this is how much we budgeted to do this stuff, then it's great. The main challenge is that for some people that they see this pile of money and they use it to generate unsustainable growth because they consider that I want to show this amount of growth before the next raise. And they could have probably raised without showing that crazy spend. In fact, sometimes that crazy spend and unit economics hurts their case more than it helps. So if you have a team, and every team thinks that they're the ones who are going to be different, they're the ones who are going to be disciplined with money. If you can kind of instill that and not spend tomorrow's dollar today, then sure. Otherwise, raise, like, VC funding is the worst source of capital. So like you only take it because you're the only kinds of businesses that can benefit from it. Otherwise, like, customer money is a lot better. In some cases, some business models, you can access debt, which will be less dilutive, but usually debt and equity needs to be paired together. If any of you guys are raising debt, then what I would typically advise is that you go through the debt ICs before. They won't give you the money. They'll say you need to raise this much equity. But when you're pitching to like a Series A or Series B investor for your equity part of your raise, they'll see that, oh, you're pre-approved for this line of debt. So you've taken away like one of the key risks in the model. And I feel like, okay, these guys, like, one of the key risks I was worried about was whether they could actually finance this business model, especially if you're like any of the, like, you've got an embedded finance or a BNPL component in your business model. Prove that you can access the debt beforehand. And then with that, the raise will be a lot easier.
And then one other thing, and I'm just bringing this up because you mentioned it in one of our mentoring sessions. I think some of the others will benefit. We had this perception that an investor who's also a customer was a good thing, right? Our perception was, and you gave some examples where it wasn't. So I think some of the others might benefit from sharing that.
Yeah. So look, there's strategics and there's customer money as investors. The reason I don't like customer money as your investor is because they get access to information. They're like, oh, we're so profitable. We've got 70% margin because these customers keep loving our product, keep buying it. And once they know exactly how much you're fleecing them, you might not be very comfortable with that information. Also means that it's harder to say no to a customer and to fire the customer if they're an unhelpful or toxic customer. So you've made life very complicated. So I like simple things. If you're attracted to the idea of, dating and marrying somebody from work, then maybe you like this, but I am not. So
that's a good analogy. And one last point, Saif, sorry, and you can have the mic back. One of the things that we've learned over the process of our raise is some of the early investors who said no to us, and we were quite lucky. We got some good feedback, right? These are the reasons why they said no, whatever. Because the fund process has taken so long, and we never expected it to take this long, the business has matured over that time. And some of the feedback we've taken on board, like some of it legitimately we've taken on board, some of it probably by accident we've taken on board. And then we've then had conversations again with them, right? And the time period is it's been about 6 months, right? So much so that they're re-interested in us now, right? And it's proved to be really, really useful, right? Because it showed they knew us, they got to know us from the first interaction. B, even though with one of the investors it wasn't intentional, it looks like we listened to the advice, took it on board, adapted the business model. And so this second conversation now has become a lot more powerful in that. And so sometimes it is frustrating that some of these timelines for the raises are really, really long, but there are some unintended benefits and consequences, unintended good consequences that have come out through these elongated processes.
There's nothing better than telling an investor they were right, and we followed their advice, and we've seen the benefits of that. So we've been a direct beneficiary of that process.
Yeah. After the raise, your ability to communicate, to provide updates to both those who invested and who did not invest is going to be the best source of FOMO that you have. There are many deals where, like, I'm on the fence, and every time they send an update, I'm kind of reading it, kind of looking at it, and maybe I tried to convince the partnership, but I couldn't get it through. And then I can keep, hey, like, see, guys, I said this deal is good. Wasn't I right? Do you want to catch before it flies off? Do you want to see if we can write a preemptive check? Can we talk? Can we do this? and it allows them to get it sometimes through the door, and that's where you'll find them converting, even though they might have passed in the first time. And especially like there is no better, like one of the best predictors is just quality of updates. The founders that are consistent with their quarterly or monthly updates uh, are so like correlated with the ones that perform the most because they're disciplined. They have a very structured thing. A lot of the founders kind of trick themselves into, oh, I don't have anything to share. I don't have a lot of good news. Nobody's reading. Nobody replied to them. Nobody's opening these emails. Therefore, I should probably not do them anymore. That's how the sloppy founders trick themselves into this is not worth doing. Trust me, it is. And it will make a difference. Now, one of you guys did mention, how is it that I can decide what the valuations should be? Like if I'm talking about this raise and the next one. So what I'm gonna be posting something here and see if I can attach a PDF to the chat here. These are two reports done this year on MENA valuations. Now, what these will give you is data points. They'll tell you what the average pre-seed raise is. They'll tell you what the average seed raise is, what the average bridge, what the average Series A is. If you are very far away from those numbers, you need to have a really good justification logic. If you're selling me a Series A price for a seed stage company, you'd better have some really compelling reasons for why not. If you find yourselves outliers in whichever raise you're raising, catch yourself so that you don't start off so far out and you're able to come up in a relatively respectable. Most of the times, investors aren't going to be too peculiar about like 5 versus 6, but if they hear 8 in a seed stage deal that they see as very similar to the other seed stage deals that they've been exposed to and the ones that they've been considering, they're going to wonder why. And you'll get the historical. So for example, like we're seeing there's a general uptrend in pre-seed and seed deals in terms of valuations. But if you notice that the Series B and C valuations are kind of stagnant these days. So there is less late stage and more early stage capital, even though sometimes it doesn't feel like it, but the data does show that the average prices are growing and our fund strategy is adapting. So for example, what I used to do in what we used to deploy in 12 companies, we're deploying in 9. We just have to adapt our model because average seed valuations are increasing and we have to adapt to it. So I think with this, let me see if I've covered every single question. Okay, the first question of mandate and what do they want? Will they invest with these terms? And it's also kind of related to timing. So there are some times where a founder will pitch me and I'll see them a year later and I'm like, thank God I did not invest a year ago because nothing's changed. And maybe this is the right time to invest. It's not often a signal of never invest now, but it's like, oh, that was too early. Usually the red flags from don't invest now are when the founder is over optimistic around some things that I know are challenging. Oh, we have a deal with Ilm, and we're also gonna be working on our fintech sandbox, and we're gonna get into the into the sandbox within 2 months. Like, oh, okay, like famous last words. So in that case, I'll just know that they'll need a year to figure this stuff out. They'll need a year to understand how much time everything really takes, and I'll wait till the world has taught them that lesson before I invest. So on a matter of timing, your ability to understand what it really takes to do what you're projecting is going to be the biggest sense for how reliable are you as a predictor for how long things will take. Usually founders underestimate how long regulatory licensing approvals take. They underestimate how long big key enterprise contracts take. So those are your 2 red flags. What do they want? Now, I wish things were as clear as what do investors want. I'll tell you that they're more factual when it comes to follow-on than when it comes to that first check. So there are many times where you write the first check on a company that you think has broken through like a ceiling. For example, there's a lot of SaaS companies that might hit 500,000 ARR relatively quickly. Some of them will hit 1 million, but they sometimes kind of stay at that level and struggle to go beyond it. Those are the companies typically where the founder drives everything, and once the founder has exerted his capacity, he's not able to build and train a huge sales team that is rapidly growing that subscriber base. So they tend to sometimes stagnate at that level. If you're writing a follow-on check, it's good discipline to see like which are the ones that have broken through these glass ceilings before they and everybody else has realized it. And if you're an A+ investor, you try to preemptively invest in that raise. So I'll preemptively talk to you, say, hey, like things are going well. We want to put more money in so that you've got more momentum going into your next raise. Now, what this says is like, you're doing awesome, take more money. But what I'm really saying is, hey, before you get expensive and you realize what you're worth, I want to put some more money in and own more of your company. So follow-ons typically are more structured. The best funds will have a different person having the follow-on decision made, because you can only do follow-on maybe 5 of your 20 deals. You want to make sure that it's not somebody who made that initial commitment and feels personally attached to the deal and will be defensive if the deal is not done, especially if they've got a good relationship with you. There's a drive. The best ones will have somebody else who's totally has no attachment to the company, no attachment to the product, decide if they met you for the first time today, would they still invest at this price? So follow-ons will be more rational. Early on, you're going to deal with a lot of perceptions of the industry. And I think in the case of FIFO Plus, we spoke about that early on. We said fundraising is going to be tough. Investors are scared of this model. You are going to have to, by day one, say, here's why this model didn't work. Here's why we're different. Here's the data that proves us out. If you're not willing to address it, you just want to talk around it. You don't want to remove the key Achilles heel. Removing a fear is more effective than kind of seducing them with the upside. Then you've got a shot at actually having an honest debate with somebody. Super helpful sometimes if it's a founder who's got so much domain expertise and can credibly speak about the other sectors. So for example, how many over the years when you've gone to so many events, how many beauty salon SaaS companies have you guys seen that allow a beauty salon owner to book sessions and handle payment and manage the back end and everything? I've seen one almost every year. Each one tells me they've figured it out. Nobody has yet to like super dominate the region with it. There are some front runners now, yes, but when they first started, it was 1,000,001 and very little differentiating factor. Our last IC, we had 9 companies. I think 7 of them were AI companies. Each one was saying they're the only ones doing what they're doing. I know they're not, because in the same day I'm talking to all of them. I'm going to have to make 1 or 2 bets at most if I decide to make a bet. There was one time where we had 3 logistics companies, competitors in the exact same space. After talking to all of them, we decided not to invest in any single one. We just didn't like the model, felt too commoditized, too easily replicable. I wish I could give you like a clear signal of if you do this, you will raise. For debt, it's a lot clearer. For early stage, pre-seed to pre-A, it's going to be murky. Nobody knows. And it's going to be a lot of gut feeling and judgment from everybody else. All right. I think we covered most of them. Oh, and if your answer to why you're better than your competitor is that the market is big and can hold both of us, you're copping out and you're running away from the question. So please don't do that. And I think that covers it. So Any other questions? So I see, what is the biggest red flag in a founder's behavior? I think easily lying. The moment we catch a founder in a lie, it is the fastest way to write them off and have zero regrets. Prakesh, is your hand up because you forgot it? Or okay. That's so there's a signal for physically to raise the hand, but there's no signal to reduce the hand digitally. All right.
It sometimes automatically says after his head I spoke, then it comes out. But the last time I cancelled it, and so now I think it just stays permanently. So
You
it
need
is
to raise it
trying to
slow.
be clever, but not. Yeah.
You raise it
Nope.
slow, like computer.
Yeah.
I think this is
Omar,
the
go
time
ahead.
to create a venture. So you can, when you disable your mic, automatically it will be cancel your raising hand. This is maybe a feature we can think about it. Thank you.
Thank you, Awesome, for the tech tips. Omar, I see your hands up. What's up?
Hi. So first of all, thank you for all the insights. Highly appreciated. I had a question regarding labeling rounds, especially when it comes to pre-seed and seed. And the thing is, how do you label a round? It doesn't matter. If it matters, which way do you go? What do you decide is the better for you also?
Pre-seed, usually it's pre-product. Seed, it's post-product. There's some initial, like, small customer base that you can DD. Series A, it's typically an equity round. Ideally, north of $3 million. And let's say, like, there is a valuation range that you can see in the report. I think the tricky one is bridge. If you're raising a bridge, it means there are specific metrics you need to hit in order to raise the A round. And if I ask you what those metrics are, and based on what you got those metrics, and they're all based on vibes and feelings, then it's a bridge to nowhere and it's not a good investment. So beware of the bridge without a specified target at the end of it.
Cool. Okay, but just a quick follow-up. I think the main reason I'm asking this, and your answer makes sense, but one of the things like in our case, so we're basically kind of pivoting our business model the way we're working at the moment. And kind of feels like, I don't know if we're seed or pre-seed because things are changing a bit at the time we're fundraising. So I'm not sure if we label this round as pre-seed, is that a bad thing? If we label it as seed, is that a good thing? What does each indicate?
I mean, in your case, you're raising at, are you comfortable sharing the cap? If not, I'll talk around it.
I think, yeah, it's fine.
All right, you know what? At the cap that you're raising,
Okay.
I don't think you should raise a pre-seed because you're setting up for like a crazy high seed, and that makes no sense. If you feel like you really are pre-product and you won't know what it would take to grow the business, you can call it a seed. At the pre-seed seed stage, I'm less picky. It's the seed plus bridge plus A is where I try to kind of clearly have lines demarcated. So I've seen founders try to raise an A with notes. Why? If you're raising north of 3 million, it's good to do an equity just so that your investors start diluting with you. Because with notes, only you, the founders, get diluted. Once you raise an equity round, your investors also get diluted, so it protects your ownership a little bit. So the faster you can get to a good qualified A round, the better it is for your outcomes.
Makes sense.
Yeah. So if you feel like the model works, the product is mature, then call it a seed. If you feel like I'm not sure about the product, I have no idea, I'm considering this pre-product, then call it a pre.
And it's very less common to raise a seed round at a priced round. Is that correct? Like it's usually convertibles.
Yeah. It's
okay.
much of a logistical headache at that point.
Cool. Makes sense. Makes sense.
Transaction costs increase. So the reason I'm saying 3 mil is because like there's cost to doing a price round, and you know, past a certain point, it's not worth to pay the lawyers and everybody to get it done.
Just a quick question on the Series A parameter in today's market. So what are kind of, do you think about the round size, the revenue? What are the kind of high level, you can say, parameters that is going around for Series A in the region, Saudi specifically?
Series A is probably the most confused round these days, because you've got Series B and C are kind of stagnant, and you've got Series A, seed kind of crawling up. So Series A is in this weird no man's zone these days. But typically, we're like a Series A deal, they're raising 3 to 8 million. Typically equity round. In some cases, I've seen 10. Really depends on the sector they're in and the amount of money that is needed in that sector. But I think the average, let's see, deal value for an A as of last year was 12 million. So it shows you that there's a huge gap amongst there's huge variance amongst the companies. And if I'm looking at UAE and Saudi are kind of the same. But a lot of the reason seed prices went up is during the past couple of years, a lot of funds obviously were created during COVID, and there was a run up during COVID. And the fund managers who realized that, oh, my model, when I first raised this fund from my LPs, took into account the average deal size is this, and my portfolio construction would look like this. And then they were met with ballooning valuations. So they're like, oh, I can't get the portfolio diversification in my A fund when I first raised this from LPs. So either they went blindly and just invested in less companies and took on more risk with each deal, or they took a step back and took on earlier stage deals to kind of stay within the price range that they raised at. So I think if you look at Nua Capital is a good example of a fund that was originally supposed to just target Series A, but ended up doing a couple of seed deals.
And any other numbers on like revenue, like people, maturity?
Unfortunately, that will depend from sector to sector. So if it's fintech and you have a license, you're
No, it leaves it fintech. I think more SaaS, more other.
SaaS. I mean, you'll go with different multiples, but in every single case, I'll give you one company that broke the rules and raised at a higher cap with lower metrics. Either they've got some deals, either they've got some interest. For example, if you look at one of the companies that's really popping these days, Gathering, for example, there's so much interest in their later rounds. You've got a couple of pre-IPO funds now chasing the later stage. Those will be a little bit more metrics driven. Most Series A investors you speak to will tell you, and I'm sure you've heard this a million times, Yusuf, will tell you like we want $1 million in ARR, north of $1 million, we're excited. But they're not just looking at that. They're also looking at your growth rate. And it's like, oh, these guys have an average growth rate of like a 10% 1 month over month for the past few years, consistently growing ARR, consistently growing net new ARR. Then suddenly it's a much more metrics driven game. But does that mean that if you hit these numbers, they will guaranteed invest? No, they'll come up if they have if they have an internal thought that they should not invest in this company, they will manufacture other justifications. They say, well, it's growing well now, but I don't think the market's big enough. I think they're going to plateau. Like they'll always be able to find a way to argue themselves out of a deal. The only thing that will shake them out is if somebody says that they're wrong, other than the founder. It's like, oh, X person is super disciplined in this area, and they're writing a check. For example, with one of our deals, like we had one VC, like they had one commitment, and as soon as that commitment came in, everybody came flooding. And to the extent that the founder is like, I never thought I'd be saying no to money. Like I've spent 1 month begging, no, but none of them responding. Now they're like fighting for allocation. And when the founder says I can't, they call me. They call Amal. They're like, hey, like we want space in this deal. The founder isn't giving us allocation. Can you please talk to the founder? And this is the exact same person I was begging to meet the founder like 2 weeks ago. So you do get pulled in these bizarre situations, but it was that moment in time, like that first person who did the modeling understands that thing broke. Like, and I got all sorts of feedback for why they can't invest. Like one of the investors said, I cannot invest. The valuation is too high. We never get in at this price. When they felt like they were missing out on the deal, they were offering to give an additional higher price than the one they initially balked at. So I was like, oh, like you said you can't do X, but you're willing to do X plus 5 million? So it just goes to show like there's very little logic, and there is I want to get into the cool kids club sometimes. Awesome, go ahead.
Thank you very much, Abdulrahman. Abdulrahman, since we are heading to the seed round, so we are a little bit confused either to go with the price round, with the equity dilution, or we make it safe notes. And shall we heading with VCs or angels? These actually components are looming around my mind a lot of time. So if you can advise us based on experience, benchmark, how can we adapt this round? Thank you.
All right. So the first thing you need to address as you're prepping your round is why. Why am I raising this round? What is the objective of this raise? If you don't have a good answer to this question, it doesn't make, like, I don't even know why you're talking to me as an investor. So there needs to be like a key objective. We're raising this round to achieve this thing. Right? And that needs to be super correlated with what you need to raise the next one and the next one, and the next one. If you don't understand what those metrics are, then you need to sit down, talk to a couple of good investors, good founders to get to know, like, I need to hit this, hit this, hit this. For angels, it's fine to register and sign up to some of the angel networks, Riyadh Angels, Aqal, Dubai Angels. There's a bunch, right? Usually the forums look the same. So have the answers in a Word document. It won't take you much time to fill them. What I will recommend about angel groups, the percentage of you closing, and this is data from Aqal, the percentage of you closing with angels is significantly higher if you have at least 30% of your round committed. So do not pitch to angels cold, especially if it's an angel group. If it's one specific angel who understands the sector deeply, who, because they understand the sector, will be able to come to like a decision with more confidence, then talk to them.
Okay.
Get them in on a one-on-one basis. But do not pitch to a general group unless you've got like at least 30% of the round committed. Once there, you can get a couple of angels. They'll make a few additional intros. They might bring a couple of friends, and you can get some additional allocation there. Do not decide, should I or shouldn't I? You pitch to everybody, and then you decide who you want to let in.
But Abdulrahman, why you are not recommending to pitch in front of multiple angels? Because if this is not only with that his area of expertise, at least we will educate, aware him about what we are going to.
I am telling you to pitch to angels. I'm just telling you not to do it when you have zero allocation.
Okay.
Because like you guys are optimizing conversion rates, right? So I want to maximize my conversion. If I know that my likelihood of closing angels is almost doubled when I have 30% of my round committed, then I should get that commitment first, then go pitch to angels.
Yeah, okay, clear. And which approach you would like to suggest, either to the safe, let's say, approach?
I think if you're raising a seed, I would recommend a safe. Equity round has so much more like complexity and paperwork and headaches. You yourself, when you, like, let's say you only have a Saudi company, If you don't have an international holding company and your investors own a piece of your Saudi company, the paperwork you'll need for anything that requires like all shareholders to approve, the signatures you'll need, it's just not worth it. So keep it light, easy, do notes, have a common law holding entity, either ADGM, either Delaware, Cayman, whatever. Just keep it simple as much as possible.
Perfect. Thank you.
No worries. All right. I think we've spent a considerable amount of time on this. So one final word on the perception of stages. If you're raising a pre-seed, what you're saying is, I need to prove that I can build a product that people like. If you're raising a seed, you're trying to prove that there is real product market fit and that there is the beginnings of a good growth cycle in your product. If you're raising an A, you're saying, I can not only maintain, I can accelerate this growth. And here's how I've built the sales team. Here's how I'm hiring this. Here's my ability to generate extra traction. Each raise has an assumption built behind it. I've seen some seasoned entrepreneurs trip up because they keep wanting to reinvent themselves in every single round. So I've seen a founder recently who was raising an A and wants to add a new product, wants to do like a mini pivot in a new market. And so what's basically would happen in that case is he'll go to Series A investors who are used to seeing a model that works and seeing how scalable it is and how replicable it is. And he's pitching them uncertainty. So it's the wrong product for the wrong financial product for the wrong customer. So always be aware of chasing the next shiny, exciting thing. I know it's something that you get excited about in the early days, but be aware that as you mature and mature and mature in raising, you're going to be talking to different kinds of people who want to be exposed to different kinds of risk. So make sure you know exactly what you're selling, because that's ultimately what it is. Like fundraising is not an ask, it's not a favor, it's a sale. You're selling a very, very specific financial product that only a select few in the world are happy buying and are qualified to buy. So other than that, I hope you guys do well. Like fundraising is nuts. I know you'll go insane. Sit with other founders, complain about us investors and how we act like we know what we're talking about, and it'll make you feel better at least.
Perfect. Thank you very much, Abdulrahman. Anything else to add?
Demo day, make sure that you energize, research the key investors that you want to speak to, and you don't have to get through your whole pitch. Just see that like schedule the coming meeting. Like when we say that it's easier to get like multiple offers at once, then it is a great chance that you have all these conversations at once. Make sure you divide it amongst founders. I've had one team where an investor who is highly strategic did not want to sit with them because when he met them at an event, he felt like the founder was looking at his phone half the time and wasn't really with him. And I had to spend an hour talking to this guy just to convince him to take one more meeting with them, because like his perception was like, these guys, like they knew who I am and they talk to me this way. Like how is their judgment? Look, from an investor perspective, if it's a good deal, I do it regardless of how the founder acts. Unless like there's like, especially if it's a matter of how much attention did he give me, but maybe I'm a little bit more easygoing. You're going to talk to people who are much more brittle and gentle skinned than I am. So make sure that when you have these conversations, especially with high priority targets, that you give it your focus and divide amongst your co-founders. And that's it. I think we're good to go. Maryam, anything else that we need to cover?
No, that's basically it. يعطيك العافية. Thank you so much for spending the last 2 hours with us. You're still getting questions as we speak. I can see Omar has his hand up. So at the last moment. So Omar, any final question?
Not a question, just a quick thing. By the way, the
Okay.
other time when I was holding my phone talking to you, it was a family emergency.
I told you I'm not easily offended.
I'm just kidding. Yeah.
It's okay. It's
Thank you for the clarification, Omar. But noted إنه Abdulrahman is easygoing, while others might not be as easygoing as him. So
Yeah,
just be
I
sure to
know,
be
I know. I'm
mindful.
just kidding. For sure, for
Yes.
sure.
Okay. Perfect. Thanks
also,
again, Abdulrahman.
Mariam, I just remembered one thing. Some of you have been pitching for so long that you hate your pitch, and the energy is like your soul is leaving your body as you tell me about your company. Sorry, that's not how a professional acts. A professional does it right, perfect the first time, every time. Full energy, full enthusiasm. I know by week 1 you're excited, and maybe by week 8 you're less enthused to go through the same song and dance and answer the same questions with the same level of energy. And I know after you receive a certain amount of no's, you feel like, oh, these investors, why am I even here? If you don't want to raise, don't raise, don't talk to them. But don't talk with this toxic energy emanating. Like I've had one IC where we had 9 companies in one day, and I think it was company 6 where the founders seemed to actively hate pitching. And at the end of it, like I just felt like the energy was entirely sucked out of me. Like we needed to take like a 20-minute break. Everybody go get coffee, because I don't think we can talk to any more founders after that one. I know like this might seem like a tiny point, but it makes all the difference. Okay.
100%. Couldn't agree more. So with that, guys, as you know, you've been pitching in the pitching clinics. A lot of you have gotten a good start, but a lot of you need a lot more pitching and a lot more time with us. So please be sure to book your pitch practices, reach out to other mentors, reach out to us for us to support you guys mainly, because we're only around 6 weeks away, and these 6 weeks are actually going to run by so fast. And we want to make sure that you guys are ready, you guys are pumped, you guys are excited, and you guys are confident in your pitches and are ready to talk to investors in all aspects, in terms of your financials, in terms of your company, in terms of all of that, in terms of your growth, in terms of your numbers as well. So not only pitch. It's nice to beautify a present from the outside. However, when you open a present and people get disappointed from inside as well, you need to make sure that everything is well structured and everything is ready to go. So always be sure to always be prepared, work on your growth, and reach out to us whenever you need support. And with that, hope everyone has a great evening ahead. Thanks again, Abdulrahman, for your time. And hope everyone is pumped and is excited for the next weeks to come.